Okay, good morning, ladies and gentlemen. Welcome to the International Visiting Lecture with DMI St John the Baptist University, Malawi. Welcome to the Honorable Mr. King Chizimba as a lecturer from DMI St John the Baptist University. As for the topic today is cost and financial analysis in attainment of tangible profit. Yeah. And for today's session is being live streamed on the University STEKOM YouTube channel. And now I will read our agenda this afternoon. First, we will start class presentation delivered by Mr. Mafumu and continue with the Q&A session after already presentation. In the next session, we have time for documentation and last time is closing. Okay, let's begin. We will start class presentation delivered by Mr. Mafumu. The time is yours. Thank you.
Thank you very much. Today, I will take you through my presentation on cost and financial analysis in the attainment of tangible profits. I believe my presentation is visible.
Yes, sir.
Yeah, so first of all, more especially in the global economy, we do understand that businesses and companies, small, medium enterprises play a significant role in economic growth as well as economic development. But for them to flourish, for them to be productive, for them to be efficient, it all comes down to the cost and the financial analysis that they do have. So cost and financial analysis plays a critical role in achieving tangible profits by ensuring effective management of resources, controlling of expenses, and maximizing revenues. So the core aspect of businesses in the global landscape is to ensure that they're able to manage resources, the scarce resources that they have, and at the same time, to be able to control the expenses and as well as maximize the revenues. So whenever we talk about the expenses are divided into a number of categories. For example, we can have the fixed costs, we can have the variable costs, as well as the direct costs. So when we talk about the fixed costs, these are costs that do not vary with the levels of production. So for example, you can talk about the rentals, the salaries. These are to be paid regardless of whether or not the production is there. And at the same time, we talk about the variable costs. So the variable costs, they vary depending upon the production output. So the more you produce, the more you spend in regards to raw materials and the like. So a business, the first way in which a business is to make profits is to reduce the expenditure, to reduce or to control their expenses. So that comes down to the cost analysis. What are our expenses? What is our cost structure? And what can we do in order to reduce our expenditures and in the long run be profitable? And the second aspect of my presentation, I'll focus on the financial analysis. So financial analysis, we are trying to analyze or evaluate the company's overall financial health and profitability, right? So us as a company, us as a business, are we healthy as far as our financials are concerned? Are we profitable in the long run? Remember, a business or a company is to portray itself as a going concern, meaning to say it will be there into the foreseeable future. But for that to happen, we are to also understand the financial health as well as the profitability. And also to try to analyze our revenues, analyze our sources of income, to understand our pricing strategies, and also to understand our sales performance for us to maximize our revenues. So when it comes to financial analysis as well as the cost analysis, one of the most crucial documents that we do rely upon are the financial statements that businesses are required to prepare. So when we talk about financial statement, it is an official document of a firm which explores the entire financial information of the firm. So for example, a business is to produce a number of statements. And on these statements, they portray a different purpose. So for example, if we want to look at the profitability of the business, we are to look at the statement of comprehensive income. If we are to understand the financial position, we look at the statement of financial position. And at the same time, if we are to understand the cash flows, we have the statement of cash flows, as well as the statement of equity. So this statement provides us with the necessary information of how our business or our company is performing on our financial health. Are we healthy enough to handle our liabilities? Do we stand in a position whereby we are profitable? Do we have the proper line of expenses? What is our cost structure? So they do help us understand. So the first step of conducting a cost and financial analysis is to have a clear statements, or fluid statements that give us the right information on how our businesses or our company is performing. So you can also define them as a set of reports or schedules which an accountant prepares at the end of a period of time for a business enterprise. So usually the statements are prepared at the end of the financial year. So at the end of each and every financial year, we are required to prepare the financial statements from which we can conduct our analysis, and also for the sake of stakeholders or shareholders who may have an interest in the running and the performance of the firm or the company. So as I stated earlier on, that we have a number of statements that have different purposes and are very essential to us. So for example, we have the statement of profit or loss, also the comprehensive income. So the statement of profit and loss, it shows us all the way from the trading account, showing us our expense, our sales, our purchases, our direct expenses, our gross profits, and all the way to our operating expenses, and also giving us the net profit of how we performed in that accounting period. So from this one, we can tell whether we are profitable or not. And also we are also able to understand our expenses as far as the direct and indirect expenses are concerned, or the operating expenses that we do have, whether in selling and distribution or in marketing or administrative expenses. It will be clearly portrayed in the statement of profit or loss or comprehensive income. And at the same time, we have the statement of financial position. So the statement of financial position was formerly known as the balance sheet, and it is orchestrated or formulated on the accounting equation. So the accounting equation states that assets are equal to capital plus liabilities. So it shows you your assets, it shows you your liabilities, and at the same time, it shows you your capital. So this statement is very important, usually because it clearly portrays on whether you are able to meet your obligations. So when we talk about obligations, we are talking about whether it's debt. Maybe you borrowed money, long-term loan from the bank. So in a scenario whereby you were to dissolve your assets, will your assets be able to pay off your long-term obligations or short-term obligations? So that's what the statement of financial position tells us. It portrays that financial position. Do we have a positive or a negative financial position? And also we have the statement of changes in equity, and it portrays much to the equity shareholders. And at the same time, we have the statement of cash flow. So the statement of cash flow simply shows or illustrates the cash inflows and the cash outflows. What is our cash from the operating activities, from the investment activities, or from the financial activities? So it gives us a clear picture of what's happening with our cash flow. Do we have a positive or a negative cash flow? So all these statements are very, very important, and analyzing such statements will help us know whether or not we are profitable, or we can be able to attain profits in the long term or short term. So understanding that the financial statements help us in the analysis or help us in coming up with proper cost and financial analysis, it is also very important that we prepare them properly, right? Because if the financial statements are not well done, then it means they'll give us the wrong information and our analysis will not be relevant, right? So we have a number of attributes of the financial statements. The first one is relevance. The financial statements must contain relevant information for them to be useful to others. And by others, we're talking about both internal users as well as external users. So internal users, you can have the managers, the accounts department, and external users, you have even the investors, the shareholders, would want to have a financial statement that has relevant or is relevant as far as this information is concerned. And also, the financial statements should be accurate and free from bias. Meaning to say, he who prepares the financial statements should ensure that he has used the right accounting concepts, the right standards. He has ensured that the financial statements have the right details, the right figures, and there's consistency in the methods that have been used. And also understandability, you should easily understand. It should be easy for the user to understand what is being portrayed on the financial statements. So someone who has basic accounting knowledge or in finance or accounting should be able to understand or comprehend the information that has been presented in the statements. And also, above everything else, the financial statements should be in compliance with the law, right? So what does the law say when we talk about the preparation of the financial statements? Do they state that we abide by standards? For example, the International Financial Reporting Standards or the International Accounting Standards? What does the law say? So if we follow all these things, all these points or principles, then it ensures that our financial statements have been well prepared and it will be very easy for us to analyze and have accurate results. And adding on to that, it is also very important to understand that our financial statements should oblige to accounting concepts. So we have a number of accounting concepts. For example, the historical concepts, right? Which talks about how do we evaluate our assets, right? So you value your assets based on the initial costs of those particular assets. And these assets, you usually find them in the statement of financial position. And also, in accounting, we're dealing with numbers, meaning to say that the information that is portrayed in the financial statements should be in monetary terms, right? So we have the money measurement concepts. It is easy to analyze information that is has been portrayed in a certain units or measurement. For instance, money. So money is very easy to analyze the information that is portrayed in the financial statements. And also, we also have the business entity concept. So the business entity concept illustrates that the business entity and the owners are two separate entities. So you have the business as well as the owners, and they should be treated likewise as separate entities. And also we have the dual aspect. The dual aspect says that for every transaction, you have two sides. So you can have a debit, you can have a credit, and that is also portrayed well with the accounting equation. And also the time interval concept. The time interval concept. So the statements are to be prepared at regular intervals, usually within an accounting period or an accounting year. So those are some of the concepts that we are to follow in ensuring that we have the right statements from which we can draw our analysis. And also, whenever we are preparing the statements, we are also supposed to understand the going concern concept. So the going concern concept simply states that the business will continue to operate for a foreseeable future. It shall be there for a certain period of time into the future, right? So whenever you're preparing the financial statement, this should be clearly portrayed. in the business to say it's a going concern. And consistency, because in accounting we have a number of procedures, or a number of concepts, or a number of methods. For example, when it comes to calculating depreciation, you can have the straight line method as well as the reducing balance, right? So if your business or your company is calculating depreciation, it can use either. So for example, if you choose to use the straight line, you should maintain it, right? So that goes alongside with the consistency concept, right? You stick to the method that you have chosen when it comes to the treatment of certain items or certain variables in your financial statements. Prudence. Yeah, so we have also the concept of prudence, which states that accountants should always exercise caution when dealing with uncertainty, while at the same time ensuring that the financial statements are neutral, such as the assets or the income. So it is very important to say, whenever we're dealing with uncertainties, as far as the financial statements are concerned, we should make sure not to overstate or understate, because it is very easy to overstate your incomes and understate your expenses. And in the end, when it comes to you analyzing those statements, you will not be able to come up with viable results. So it is very important also to have prudence when it comes to the formulation of such statements. And the accrual concept also states that the net profit is the difference between the revenue as well as the expenses incurred in generating the revenues. Yeah, so this concept implies that all income and charges relating to the period to the financial statements should be taken into account without regard to the date of the receipt. So you record the transaction on the date that they occurred, despite when the receipt or the payment was made. So above that, we are also supposed to ensure that the financial statements have this element of full disclosure. So full disclosure is a principle that states that all the relevant and necessary information for the understanding of a company's financial statements must be included in the public company filings. So you are supposed to include every relevant information, because if you don't include the relevant information in the financial statements, then you might easily misguide your users, or the internal or the external users, to that particular information. So include all the relevant and all the necessary information, as this will also result in a proper analysis of your financial statements. And also, your financial statements should be in line with the generally accepted accounting principles, right? So these are the acceptable principles that we have worldwide, and they're very important when it comes to financial reporting. So to ensure that there is consistency, or there is obliging to these standards, it makes it easier for external users from all over the world to analyze our statements. So now, to the topic at hand, we go to the financial statement analysis. So this is a method of reviewing or analyzing a company's accounting reports in order to measure its past, its present, and also projected future performance. So now, with the financial statement analysis, we're saying, how has our company performed over a certain period of time? Can we say we are better off? Can we say that maybe we are lacking somewhere and we need to improve? So the financial statement analysis helps us in portraying on whether or not we are performing. As a going concern, are we being profitable? Or maybe there's something we need to do, or some measures we have to put in place. So we have a number of ways in which we do analyze statements. But before that, the objectives of financial analysis. So to assess the past performance as well as the current position. Were we better off in the past? And how does that compare to our current position? And also to predict the net income and growth. So if you go back to the statement of profit and loss, where you have your net profits or your net income, where do we stand? Are we growing as far as our profits are concerned, or maybe we have to improve or come up with certain measures to help us flourish? And also to predict bankruptcy and failure. Have we ceased in becoming profitable? Are we going bankrupt? And maybe we are likely to fail. So that is also shown with the financial statement analysis, and also the loan decision by the financial institutions and banks. So usually financial institutions like banks or other small financial institutions would like to see our financial statements to see whether we'll be able to pay back the loans that have been given to us. So we have a number of tools that we can use to analyze financial statements. So for example, we have the common size analysis. So the common size analysis displays each line item of a financial statement as a percentage of a base figure to determine how your company is performing year over year. So you can have a common size income statement or a common size balance sheet. So if you have a common size income statement, that means this analysis is mostly focusing on the statement of profit and loss, or from the statement of comprehensive income. So in your comprehensive income, you have your sales, you have your purchases, you have your opening stock, your closing stock, you have the operating expenses, all the way to your net profit. So with this one, you're comparing each item of your income statement to your sales. So your sale is taken as 100% or 100, and you compare each item, whether it's your expenses, whatever it may be, to your sales, and to see how you're performing in regards to your sales. So this reveals the efficiency of a firm in generating revenue, which leads to profitability. So this is one of the approaches you can take, analyzing your income statement. And at the same time, you can also have a common size balance sheet, whereby you have the total asset side or liability side taken as 100%, and all figures of assets and liabilities and capitals are expressed as a proportion to the total. So you're comparing your items in regards to total assets or to the total liabilities in order to see your financial health or even your long-term solvency, or also to see if you're able to meet your short-term obligations as well as liquidity position of the enterprise. Yeah, so for example, I managed to insert an example for us. We have a common size income statement of XYZ Limited for the years 2015 and 2016. So you have your net sales. You have your net sales, and as you can see for both years, the net sales is expressed as 100%. Same for 2016. So what we're doing is we are comparing our items to our sales. So for example, for 2015, we have less cost of goods sold. So you have 1190 over 14 times 100, giving you 85%. Same for the gross profit. You have a percentage of 15%. So you're able to analyze. So if you look at the 2 years, you can see that the cost of goods sold has decreased from 85% to 76%. And you can also see that the net profit for the year 2015 was approximately 9.8% and has increased to 19.32, meaning to say our net profit in regards to the common size income statement analysis, we have an increase in the profit. So if we're able to carry out our analysis like this, we can easily know whether or not we're making profits, and also it will help us attain tangible profits as far as the going concern concept is concerned. Yeah. And also we also have the horizontal analysis. So the horizontal analysis is quite different from the vertical analysis. So horizontal analysis, the financial statements are compared with several years. So based on that, a firm may take decision. So now we are comparing a number of years to say from a period of maybe 4 years, from a period of 5 years or 3 years, how has our performance been? How well have we done? And what can we do better? And this goes back to our initial statements. So you're comparing your statements to a number of years. And if your statements are starting from 2015 and ending in 2020, then 2015 will be treated as your base year. And that year will be treated as 100% in comparison to the upcoming financial statements. Yeah, so you have that as a formula, current year amount minus the base year amount divided by the year amount. And from there, you'll be able to conduct your horizontal analysis. And at the same time, the vertical analysis, the financial statements measure the relationship of quantities of various items in the financial statements on a particular period. So this one is quite similar to the common size income statements, or the common size analysis is an example of a vertical analysis, while a comparative analysis is an example of the horizontal analysis. So I think I've talked much already on the income, the common size analysis, which falls under the vertical analysis. And yeah, under which the sales are treated as 100%, under which all items are compared to the sales. So you can have the balance sheets, or you can have the income statement as far as the vertical analysis is concerned, or the common size analysis is concerned. And at the same time, you can also have a time series analysis, whereby you're trying to analyze a sequence of data points collected over an interval of time. So for example, in accounting, we have a trend analysis, which analyzes the trend of a certain time period to say, has our business flourished for the past 3, 4, 5 years, or maybe we are lacking. So you can have a time series or more of a trend analysis to see how you are performing. Yeah, so this is the end of my presentation. I believe it was audible and we learned something today. Thank you very much.
Yeah, thank you so much for your presentation. And for our participant, if you have any question for the speaker, please add them to the chat, or you can raise your hand. We will wait until 3 minutes. Thank you. Yeah, we have one question here from participant already read in the Zoom chat. Yeah, for first question, how can post analysis be effective used to identify area of influence in a business operation? This question from Mr. Abdul. Thank you.
Thank you very much for your questions. I can see from Abdul, how can cost analysis be effectively used to identify areas of inefficiency in a business operation? Yeah, so cost analysis, as I've said, you're looking at the cost structure that a business has. So if you, for example, if you have, let's say from your income statement, you have higher operating expenses and you are operating at a loss, then that can also help you to say, these expenses, where are they coming from? Are they administrative expenses? Are they marketing expenses? Are they distribution expenses? Or maybe the inefficiencies are in regards to production. Right? So based on your analysis, you can come up with more of an interpretation, right? To say, based on these figures, what is the cause, right? Is it coming from production? Is it coming from the administrative aspect? Or is it coming from the marketing aspect? So it goes down to the interpretation that is maybe carried out by the accountant or the individual responsible for that aspect. So you can easily identify areas, because you can easily portray whether it's coming from the administrative, operational, or production aspect based on your analysis or based on your income statement. Thank you. And also, I have a question. The question talks about how do external factors like inflation or currency fluctuation affect financial analysis for profit projection? So that is a tricky one, because it is possible for us to make a profit of 100,000 last year and to make a profit of 100,000 this year. But then the two profits are different, because we have a number of economic factors. For example, inflation, you can have devaluations, you can have currency fluctuations. So based on that, it's quite tricky. But then we can still, the good thing, the financial statements give us room for including notes. So based on the notes, you can also have the knowledge of such to say we had economic factors like inflation or currency fluctuations. And if you want, you can also include other models like the net present value to discount your current profits into a more present value to see whether or not you're profitable in the long run as well. So you can have other methods or tools to project profits if you're taking into account the issues of inflation or as well as currency fluctuations as well. Thank you. Yeah, and there's another question from, is it Paulina? How does technology such as AI or automation enhance the accuracy and efficiency of cost and financial analysis? But I think over the past years, one of the challenges we've had as far as accounting is concerned is the element of human error. So with the existence of AI, I think we shall be more accurate as well as efficient. And also, as I said earlier on, to say the financial statements are to be prepared in an accounting period. We should have them on time without errors, and they will be very reliable to the external users as well as internal users as far as managing the enterprises is concerned. So I think AI is going to assist us very much. Thank you.
Yeah, thank you so much for answering. I think it's very clear answer from Professor. And I guess no one else asking again. Before I close this event, for all participants, please open your camera. I will take a picture on the count of 3. Okay, 1, 2, 3. Okay, another one. 1, 2, 3. Oh, yeah, thank you. Thank you for your presentation. Finally, we come to the end of this lecture today. We would like to thank you from Mr. Mafumu for the wonderful information and sharing your knowledge. We hope this information will be beneficial for our participants. At least we hope to have more collaboration in the future with them John the Baptist University. The visiting lecture for today in your position. Thank you and have a nice day. Thank you and goodbye.